You suggesting that this bull market is not yet over?
Oh my gosh, it hasn't even begun, David. You look back at other gold bull markets, whether it's 1971, 1976, 2000, 2008, the gold stocks typically will go up 400-500%. So we're nowhere near that at the moment, nowhere near that.
Adrian Day joins us once more. He is the president of Adrian Day Asset Management and the portfolio manager of Euro Pacific Gold Fund. We'll be talking about gold, the gold mining industry, seniors versus juniors, which should we be positioned in right now, and of course the macroeconomic drivers of the commodities and Adrian's outlook for the economy. Welcome back to the show, Adrian. Good to see you as always.
Well, thank you very much for having me, David.
It's been a few months since we were on the show. People can check out our last interview, link down below. But since then, a few key drivers of monetary policy decision have moved, namely inflation and unemployment. Let's touch on these forces first. Inflation first. So it's been cooling. 2.9% was the latest headline CPI reading. It's looking like the Federal Reserve may get their 2% if this trend continues. What do you think?
I don't think we're going to see 2% on a consistent basis unless the economy goes into a serious recession, frankly. I mean, first of all, let's not forget that even where we are now and everyone's saying how wonderful, the Fed's won and it's a soft landing, depending on whether you're looking at the month on month or the year on year, but year on year, we're still 50% higher than the Fed's own target. Month on month, of course, we're not that much. A couple of things I would say. If you look at last year's inflation numbers, you see June, July, August were peaks in inflation. That means the year-on-year comparisons are, other things being equal, going to be lower. So I think as we move into September, October, November, those year-on-year comparisons could easily get higher. You've also got the question of oil, which has had, after we talked last time, I think I said the same thing last time, but after we talked last time, we had a fall in oil. Now we've had a recovery in the oil price. Well, when the oil price moves up, it affects the price of all goods in the stores. All goods have to be transported. And so I think we're going to see higher prices in the few months ahead. I'm not looking for runaway inflation or anything like that. I just don't think we're going to get to 2% on a sustained basis, certainly not in the next several months.
It's interesting. Okay, let me just draw your attention to this BLS CPI chart. I just think it's interesting how you said that we're not going to get 2% again unless the economy falls into a serious recession. That's what you just said, right? But if you take a look at the past, Adrian, we haven't had a serious recession since 2008, and all throughout 2009 to 2020, the inflation rate has hovered around, 1 to 2%. Zero at one point in 2015. I'm just wondering why this time is different.
Well, to have inflation, you have to have three things. You have to have an increase in the money supply, whether it's from the Fed or from the banks, an increase in the money supply. That money has to go to the banks, and then the banks have to lend it. So after the great financial crisis, we certainly had the first of those. The Fed created money on steroids, but the banks were pressured and incentivized to put that money onto deposit with the Fed in reserves and not to lend it out. And so money was not getting into the real economy. And that was really true all the way through to COVID, when during the COVID lockdowns, the government started distributing money in their various programs, many of which were fraudulent, but that's another question, distributing money directly to small business and households. And so that was the missing ingredient for inflation. I mean, if the Fed creates money, but it goes to the banks and they just put it on deposit with the Fed, that's not creating inflation.
Before we continue with the video, I'd like to take a minute to talk about investing during volatility. Now, in today's volatile economy, protecting your wealth is paramount. Gold has always been seen as a trusted safeguard, but what is another low-risk way to be exposed to gold? How can you maximize returns while potentially minimizing risk? Well, the answer lies in gold royalty companies like Metalla Royalty and streaming. Metalla has one of the highest royalty growth portfolios in the market, offering exposure to gold and the clean energy transition through their strategic copper royalties. This makes Metalla a dual investment in the future. By investing in metallic, you gain the upside of gold and copper mining without operational risks. Their expert team has curated a diverse portfolio of over 100 royalties, minimizing risk and maximizing potential returns. Don't let inflation erode your wealth. Consider metallic today to secure your financial future with the power of gold and copper royalties. Watch my full interview with CEO Brett Heath on inflation, Fed policy, and mining by clicking on the link in the video description down below. But the question is, why necessarily do we need a recession this time for the inflation rate to go to 2%? Because again, as you saw in the past, we had 2% inflation without a recession being sustained. I'm just wondering why this
But that's
time.
when money was not getting into the real economy.
Yeah,
That genie's out of a bottle now.
yeah,
Money is in the real economy.
I see.
And you notice last time we had a recession on your graph there, the rate of inflation did drop and drop significantly.
Yes.
Then we had a recession.
Do you think that the inflation rate is telepathing a recession, given how far it's come down from its peak?
I'm not, that's not what I would say. I think there are other indicators of a recession that are that have a better track record of predicting a recession and that are more telling. So that's not something. I don't look at the rate of inflation to determine whether we're going to have a recession, frankly.
What are some of these other indicators, Adrian?
Well, I mean, there's lots of indicators, of course. I mean, one, of course, we're going to talk about unemployment. One, of course, is the Sohn rule that's had a pretty good, and there's various variations on that. But the Sohn rule is the most well known, and the one that Jerome Powell referred to, last month at his press conference. That certainly is a pretty good predictor of recession, and it's a pretty good predictor because by its nature, when unemployment goes up, that is a reflection of a weak economy. Low prices are not necessarily a reflection of a weak economy, and in fact, you can have a very strong economy with deflation, as we probably discussed before, because it's one of my pet themes. You look at Britain from 1815 after the Napoleonic War to 1914 at the eve of the First World War. That was 100 years of deflation in Great Britain, when a pound was worth more at the end of the century than at the beginning, and yet nobody would say that wasn't a period of great economic growth. So anyway, the point is, lower prices in and of themselves do not reflect recession. Higher unemployment most definitely does. And unemployment is moving up. You said we talk about unemployment. Unemployment is moving up. It's been moving up. The unemployment rate has been ticking up for 4 months now.
Yes.
But I think more important than the unemployment rate itself is the components. We've got a low labor participation rate. So if your denominator is lower, then that makes your unemployment rate lower than it would otherwise be. And most importantly of all to me is over the last 12 months, we've had a loss of well over 1 million full-time private sector jobs. So it's not a strong economy when most of your jobs are either government or government-related or part-time. That's not a strong economy. You've got this growing gap between the household survey and the payrolls report. And when the gap gets that wide, that's a signal, that's a reflection, first of all, on people having part-time jobs. That's the biggest, in my mind, that's the biggest factor that's contributing to the gap in the two government employment reports.
Right.
Some people also think illegal immigration might have something to do with it.
Yes.
And it probably does, because if you get a government officer calling you and you're calling your household, and you're an illegal immigrant, you're not going to confess to having a job. So that might be part of it. But I think the part-time employment is the biggest differential. When you get a big gap between those two surveys, typically it's the household survey that proves, because we've had these gaps before, it's the household survey that in the end proves to be the more accurate.
Yeah, that was my next question, whether or not immigration has played a factor in higher unemployment rate. So just to recap for the audience here, the unemployment rate here, I'll show you my screen once more. The unemployment rate has recently ticked up to 4.3%. The SOM rule, which you were referencing, according to the St. Louis Fed definition, is the start of a recession when the 3-month moving average of the national unemployment rate rises by 0.5 percentage points or more relative to the minimum of the 3-month averages from the previous 12 months. And that happened with the last reading, technically speaking. The labor force participation rate, which you were referencing, has been holding steady, slightly down from about a year ago. However, this immigration issue that you were talking about has people puzzled. This is a NBC article from earlier this year. It's been believed one side of the story is that the immigrants are boosting the economy. And I've heard this before, Adrian, that the unemployment rate, going back to this chart once more, has been going up not because layoffs have been surging across the board, but because rising immigration has bumped up the unemployment rate naturally. So it's not that the economy is looking weaker. It's just that there's more people out there from other countries looking for jobs. So what's that's the soft landing, no landing cap making that argument, by the way. So I'll just let you address it.
Well, yeah, I mean, I certainly don't want to get into the illegal immigration debate, but I mean, if you've got people coming into the country who are getting jobs, boosting the economy, but it means some people are not getting jobs, well, I mean, that is saying explicitly that the unemployment rate is going up. And that is not positive for the economy. It's certainly not positive for the people who don't have a job. And as you know, we've had some announcements of huge layoffs in the last month. Paramount was one. I think it was 25,000 people they were talking about laying off. But we've had a few of those large layoffs announced. So it just seems to me that it just seems to me that the unemployment rate has been ticking up for the last 4 months. The labor participation rate, which you talked about, has obviously moved up after COVID, which is what you would expect, as after people have been locked up, they get back into the labor market. So you'd expect that. But it is still pretty low on a 20-year basis.
The bottom line is, what do you think the Federal Reserve is going to do come later this year?
Well, that's always. I think Jerome Powell and many of the Fed are waiting for. They're really biting at the bit for conditions to be where they can justify a cut. So I think the odds favor a cut in September. I think to look for the market is expecting 200 basis points as 2 full percentage points over the next 12 months. That's maybe a little bit aggressive. I'm not sure we're going to get there. If they move in 25 basis point steps, that's 8 cuts. So that's basically one a meeting for the next 12 months. I'm not sure we're going to get there. But I think, I think an awful lot, and Jerome Powell has said this, an awful lot depends upon the data as it comes in. If unemployment continues to pick up, and he's made clear that that's part of their mandate, it's not just inflation. And it's really interesting that for the last, I would say, 18 months, at every press conference, Jerome Powell might refer to the dual mandate, but he spent most of his time talking about inflation. At the last meeting, he spent most of his time talking about unemployment. So I think that is something that they are now beginning to be concerned about.
I'd like to ask you about the sign behind you: conservative management and speculative markets. That's a theme in itself, Adrian. How do we do it? How do we become or maintain a conservative stance in speculative volatile markets? What's the strategy here?
That's an interesting question. That's a big theme. Well, I mean, one theme that I have is that volatility, right, is not the same as risk. That is the biggest thing we have to get into our heads. Volatility is not the same as risk. Risk is a permanent cut in value. And Warren Buffett famously has said he prefers a lumpy 20 than a flat 10. So volatility is not important. Volatility only matters to two people. It matters to people who might need money urgently, because I guarantee you, if you want money urgently, you're going to need it at a time when your volatile stocks are down. You're not going to need it when the volatile stocks are up. So that's the first person. And the second person, the second type of person, is the person who simply doesn't have the mental framework, if you like, to tolerate volatility. Some people freak out of volatility. So having laid that scene, speculative markets are more volatile, but that doesn't mean they're more risky. And you can have, very small cap stocks, whether they're gold stocks, whether they're emerging market stocks, small cap stocks by their nature are more volatile because they're thinly traded, right? But you can have small cap stocks that are much more conservative than some of the biggest cap stocks in the world, in my view. So how does one do that? I think one has to focus always on balance sheets. You focus on balance sheets. And if you look at junior gold stocks, for example, and you look at those that are going to need more money once or twice or even three times in the next year or two, versus companies that do not need money for the next 18 or 24 months, the conservative approach will be to go for those that are not going to need more money. So balance sheets will be the critical component.
Since you brought up junior gold miners, let's go into that field then. So I have a chart here that I'd like to share with you and the audience. The bar chart is the GDXJ, Junior VanEck Junior Gold Miners Index ETF, and the GDX is the VanEck Large Cap Gold Miners ETF. Why is it that the large caps have been outperforming the small caps year to date? In a bull market, both have been up, but in a bull market, shouldn't you expect the small cap stocks, the juniors in particular, to have a higher beta, thus outperforming?
Well, typically, the higher beta for juniors comes in later in the bull market. Typically, at the beginning of a bull market, it's the largest cap companies, the large miners, the large royalty companies that perform best, typically at the beginning of a bull market. And then the juniors will come in later. And I would point one thing out that I think is important to recognize, that the GDXJ is not what, I don't know about you, but it's not what I and probably many of your listeners think of as juniors. You've got Pan American,
yes, I understand,
Gold, and so on and so forth. These are not junior stocks as I think of them. But yeah, the juniors typically react later in the bull market. It's a very interesting market right now because, as everybody knows, up until recently, we really had gold performing well, but the gold stocks in general not. And we know the reasons for that. The reasons for that was because the drivers of the gold price were central banks and Chinese consumers, Chinese retail investors, who are generally going to buy bullion and not going to buy gold stocks. And so gold was driven by these factors, and Western investors, both in the US, in North America, and in Europe, were actually net sellers of gold. And so it was perfectly logical that gold was going up and the gold stocks were not. That has shifted or changed quite fundamentally in the last few months. First of all, we've had the Chinese National Bank, which was the largest buyer of gold, has not bought for 3 months. Chinese retail has been kind of soft for the last month or two. And in fact, good news overnight, good news from China, the Chinese authorities allowed the banks to increase the import quotas for gold for the various banks. That's how gold gets into China. If it doesn't come from the Shanghai Exchange, it comes through Hong Kong, imported by the banks, and then is distributed. And you don't increase quotas unless demand is picking up, I don't think. At the same time we've seen that, we've started to see net inflows into the ETFs in the West, both in Europe and in North America. Because if you remember, up until, let's say, the end of May, we were still seeing consistent, steady and consistent outflows of physical gold from the ETFs. In the last month, we've seen, let me just look at my number here. So in the last 2 years, the assets in the ETF has gone from 105 billion to 85 million. I mean, that's a huge decline given that the price of gold has gone up. You'd expect the value of the assets to have gone up. So we were getting these ongoing outflows. That has changed just really in the last couple of months, where we're beginning to see inflows as well as outflows. Now, I don't want to exaggerate that, because even over the last month, we had more outflows than inflows.
Yes.
There's been a shift. We're beginning to see inflows into the GDX.
Right.
We're still seeing outflow. Sorry, go
on. No, please continue. Outflows, yes.
We're still seeing outflows from gold stock vehicles, both mutual funds and ETFs. So if you look at your GDX, for example, even over the last month, with gold at record highs, we had more outflows than inflows. They don't report their inflows and outflows every day. I think they only report inflows, outflows if they're significant. Otherwise, they just stay in cash. They don't get invested. So in the last month, we've only had 3 days. We've only had 3 days where VanEck has reported net inflows into the GDX. That's pretty astonishing. When that turns, so I think what we have right now is, frankly, David, I think we have this very, very remarkable opportunity, because typically at the beginning of a bull market, when gold turns, typically within a month, 3 months, 6 months, the gold stocks well outperform gold, which is what you would expect. They have leverage, right? And you saw this in 2001, for example. In the first month, I think gold was up about 12% and gold stocks were up 50%. So, I mean, this is a typical pattern for the gold stocks to outperform. What we're seeing now is the gold stocks outperforming, but barely outperforming. I'm just looking at this year. Gold is up 21.5%, and the GDX is up 26%. So they're barely outperforming. And that is an unusual circumstance. And frankly, it's a circumstance as a reflection of who's buying and why they've been buying. As I just said, you don't expect the Chinese central bank, People's Bank of China, to be buying Agnico and Newmont and Barrick. You expect them to buy physical gold. As that shifts, and we're seeing the shift now, as that shifts and money moves into gold stocks, I think the moves are going to be very, very strong, and they're going to play catch up.
By the way, I'm just going to point out, since we were talking about the prospect of a recession, the last time we had a technical recession was 2020. And back then, as you can see, this is the GDX. The purple line is the GDX, and the bar chart is gold. Right, in 2020, the GDX, along with other stocks, had this huge decline here before a V-shaped recovery. I'm just saying that during periods of distress, these gold stocks are likely to sell off faster than the bullion itself. Is that something that we can expect going forward as well?
I think typically when you have a sharp drop in the market, and that's a reflection of the drop in the broad stock market. When you have a sharp drop in the market, you expect those stocks to drop.
Yeah.
We saw that, as you say, in 2001, 2020. We saw that in 2008. But, and this is very important, they tend to come back much quicker than the broad market. And you just pointed out there in 2000, the gold stocks had recovered within a couple of months. It looks like on your graph.
Yeah, this is 2020. Yeah, exactly. This is during the pandemic. Stock markets crashed by I think S&P was like 40% or 50%. Anyway, it went back up, and then that's what happened with the GDX. So big decline here, and then went back up. Gold.
And they tend to come back much, much sooner than other stocks. And so in 2008, for example,
Mhm.
the gold bottomed in August, gold
Right.
stocks bottomed in October. Gold stocks were already up 50% by March. So what's that? That's 5 months. They were already up 50% by March, which is when the S&P bottomed.
Yes.
So the gold stocks tend to drop sharply, but come back much, much sooner. And if you look at inflation, if you look at recessions generally, I mean, we're talking about a little bit apple, or we're talking about both apples and oranges here,
Mhm.
because we're talking about drops in the stock market and recessions. But if you look at recessions,
Mhm.
gold stocks actually tend to do relatively well during a recessionary period. History would show us that.
Well, you talked about this shift in buying pattern. Has that shift or change been largely responsible for the new all-time high in the gold price that we saw last week? $2,500 was breached last Friday, I believe. Uh,
I think so. I think so, definitely. But it's not so much retail people and small investors moving into ETFs. It's more people in the West, but large families, institutions, um, uh, uh, large investors who are moving into gold and moving into gold stocks. You can see that these are all OTC trades, so each trade is not reported. But of course, you see the numbers at the end of the month. You see the aggregate numbers at the end of the month, and that would suggest that there is some very, very large buying of physical gold over the counter, and it's certainly not coming from ETFs. So one surmises, and the World Gold Council surmises that this is coming from large individuals who are buying. If the buying's in London, the buying's not in Shanghai, that's another indication of this Western buying.
and you said the way that the juniors have been behaving, this behavior is indicative of the beginning of a bull market. Are you suggesting that this bull market is not yet over?
Oh my gosh, it hasn't even begun, David.
Well, it's up 30% year to date. I mean that's pretty good to me. I don't know what you're what
No,
you,
no. I think the bull market in gold stocks is just at the I won't use a baseball analogy because I'll probably mess it up, but it's just at the beginning.
yes.
Um, I mean, you look back at other gold bull markets, whether it's 1971, 1976, 2000, 2008, the gold stocks typically will go up 500%. So we're nowhere near that at the moment, nowhere near that. And the gold stocks today, even though we've had good moves this year, most of them are still, in terms of price, they're still significantly lower than where they were in 2010, 11, but most of them are even lower than where they were in 2020. Yeah, in terms of price, we've got a long way to go. And in terms of valuation, they are still very, very, very cheap. You look at a company like Agnico, for example, and you look at their free cash flow for the second quarter. So at the end of the second quarter, even though Agnico's had a good move, they are selling very, very close to their all-time low in terms of price to free cash flow, which means either you don't believe that free cash flow is going to continue, or the stocks are still very, very undervalued.
When assets go down altogether, let's just finish off here. In 2022, what happened there? The GDX was down, stocks were down, gold was down, and the broad stock markets were also down, as you know. And it was just an interesting year. You'll recall that 2022 was the year that the 60/40 portfolio stopped working as well. So bonds also didn't have a great year. And that was interesting because we didn't have a recession. So I'm just
No, but we had the Fed starting to raise rates. So
yeah.
when the Fed starts to raise rates, that's not particularly good for bonds, and it's not particularly good for gold either.
Yeah. Okay. And so, last question that the 10-year yield has been dropping from 4% down to much lower now. It's hovering around 3.8, I believe, the latest reading I'm getting. What is your outlook there? Is it going to continue dropping?
I think no, I think the longer term bonds. I don't. This is not answering your question on. You said the 10 year.
Yes, I did mention the
Yeah,
10-year. Yeah.
yeah. But I think the longer term bonds, the yields going to have to go up, unless the Fed comes back into the market buying bonds. The yields going to have to go up because the natural or the historic, the large buyers of bonds over the last 5, 10, 20 years are no longer buying, and are turning into net sellers. That's true whether you look at Russia or China, Japan with the yen strengthening and interest rates there moving up. It's the directional change that's important. So directionally, so I think we're going to have to see higher yields at the long end to entice buyers back in. I would not be buying a 10-year. All I can say is I would not be buying a 10-year bond at the yields that you have been mentioning. I think the 1 month, 3 months are still very, very attractive. 5% if you want a place to hold money, but that's not going to hold. When the Fed cuts rates, the short end rates are obviously, are obviously going to drop at that point.
Okay, Adrian, thank you very much for your updates. Where can we read your work?
Yeah, it's adrianday.com is the website.
Okay, we'll put a link in the description down below. Thank you very much, Adrian. Appreciate it. Speak soon.
Well, thank you, David. Thank you for having me.
Thank you for watching. Don't forget to like and subscribe and follow Adrian. Link down below.